Okay, so what does the gross profit margin actually tell you? Now, the key thing when it comes to the GPM, for short for gross profit margin, is that you want stability over the long term, 5 to 10 years. So what is working capital? Quite simply, it's the amount of money you need or investment that you need to keep your business running for the next year. So just 1 year. So it's a very short-term thing. But if you want to be a more serious investor, the additional step you would take is to actually look at the debt and say how much of it is short-term and how much of it is long-term. Hey there, welcome back to the channel. My name is MJ. Welcome back to the channel. Hey, did I say it again? Shit. Okay. Again. Hey there, welcome back to the channel. Best place for long-term stock investors. My name is MJ, and today we're going to talk about something very interesting, which is basically the most important ratios that you probably never heard of or is very uncommon. So we're not going to talk about things like the basic things like P ratios, ROEs, net profit. We're going to talk about ratios that you probably never heard, as I said earlier, but then it's very, very useful to you as an investor, especially if you're a serious one. So before we begin, I just want to share with you why it's important, right, to look at ratios. Financials or financial ratios, though they are not everything, but they are basically the building blocks for you as an investor if you want to understand things like industry dynamics, whether or not the company is making money, whether or not the company is efficient, whether or not the management or the CEO of the company is good. And that's why ratios are really, really important. But as I said earlier on, this video, it's all about the ones that you rarely hear of or are very, very uncommon. But before that, if you're interested in actually building a 6 to 7 figure portfolio as soon as possible, then you really need to check out our free training in the comment section or the description. So the first uncommon but important ratio you need to know as an investor is actually the gross profit margin. Now, what is the gross profit? Basically, it's whatever sales you make from your products or your service less the raw material costs. So let's use an example of an ice cream shop. So let's say you sell one ice cream for 1 ringgit. That's your revenue. What is your gross profit? To get your gross profit, all you have to do is to say, okay, 1 ringgit of revenue from the ice cream minus off maybe 50 cents of the cream, the biscuit, and maybe the chocolate in your ice cream. So if let's say the cost is 50% or 50 cents in this case, your gross profit margin will be 50%. So that's what it is. Now in accounting terms, the formula is very simple. It's actually revenue minus cost of goods sold. So that's your raw material and all that equals gross profit. So how do you get gross profit margin? You just take the gross profit divided by revenue multiplied by 100%. Okay, so what does the gross profit margin actually tell you? Now, the key thing when it comes to the GPM, for short for gross profit margin, is that you want stability over the long term, 5 to 10 years. Now, the gross profit margin, if it is stable, will tell you two very important things. The first is that the product is profitable and has demand. You see, if the margin keeps shrinking, it means that people want less and less of it. So that's not a very good thing. The second thing is that management is able to manage the business really well, just based on the GPM. How so? Now remember, a key component of the gross profit is actually the raw materials, right? Okay, so now think of yourself as a business owner. If let's say you foresee that the ice cream market is not going to do very well. Now, what should a good manager or CEO do? Should he be buying more raw materials like the cream and the biscuit and all that? Or should he be buying less? Now, I think you know the rational answer, the smart answer, right? Which is that if the business or the outlook for the ice cream market is going down, you should be buying less raw material, right? Because there's no market for it. So if you imagine if you bought a lot of this, but the market is going down, what's going to happen to your gross profit? The revenue is going to go down, but the cost of goods sold or the raw materials is going to go up. So the gross profit margin will shrink. Now, what about the reverse, right? If the business is doing well, what should the good or smart CEO be doing? He should be buying more raw materials, right? Because he needs to take advantage of the booming market, the booming ice cream market. And so, in short, stability for gross profit margin is really, really important for these two basic reasons. If you're enjoying the video so far, remember to give it a like, comment, and subscribe. Of course, click on the bell so that you know when new videos are out for you. Next ratio, ROIC, or return on invested capital. You may have heard of ROE, but I can assure you, based on my experience, ROIC is a lot better as a ratio compared to return on equity. So what is ROIC? And I'll explain to you why it's actually better than ROE later on. ROIC basically tells you how efficient the company is and the management is. So for every dollar you invest into whatever, how much are you getting back a year? That's what ROIC can tell you. And of course, I'm sure you and I agree that the more efficient a company, the better the investment. Now, what is the formula? Okay, it's a bit long, but just follow me. Okay, the formula is really simple for ROIC. It is net profit divided by invested capital. Now, that's not it, right? Because what is invested capital? So invested capital can be broken down into two important components. The first is working capital. The second is fixed asset. And if you're a business owner or you know anything about business, you know that everything when it comes to money in business is a mixture of working capital and fixed assets. So let me start with the working capital. So what is working capital? Quite simply, it's the amount of money you need or investment that you need to keep your business running for the next year. So just 1 year. So it's a very short-term thing. Now, what is the formula? You can find all these components on the balance sheet, and I'll show you one here right now. But basically, the formula is this: accounts receivable plus inventories or stock, if for those of you all who are British trained, minus accounts payable. Now, what are three of these components? I hope this is not an accounting lesson. I'll keep it as short as I can. But basically, accounts receivable is just the amount of money that your customers owe you. Inventory is the amount of stuff that you have built already, but you have not sold. And accounts payable is the amount of money you owe your suppliers. So let's go back to the ice cream example, right? So accounts receivable will be when you sell the ice cream to someone and he has not paid you. That amount is accounts receivable. Then inventory would be the cream and the chocolate that you have not used, waiting to be sold or constructed into an ice cream, sold to someone, a customer. So that would be inventory. So either it's raw materials or what we call work in progress products. Maybe the ice cream is already there, like you go to an ice cream shop, but then they have not scooped it up, put it in a cup and give it to the customer yet. So it's almost to be sold. Then accounts payable would be how much you owe the person who sold you the cream, the chocolate, the biscuit. So hopefully this is a pretty straightforward example of what working capital looks like. Okay, still following? So as you recall, ROIC or the IC or the invested capital is made up of working capital and fixed asset. So I explained to you what working capital is already. The next component is fixed asset. So what is a fixed asset? It's a lot simpler than working capital. Basically, it's all the things like your factory, the land, the equipment, the office equipment. Then for certain companies like logistics companies, maybe they have trucks, motorcycles, all the physical asset required to run the business, not in the next year, but hopefully over the long term, 5 to 10. And that's why these fixed assets are sometimes called long-term assets or long-term property, plant and equipment, which you can see right here. So now you know what invested capital is, and you'll be able to calculate the ROIC by just slapping a net income on top of it. Then it gets divided by invested capital. So you might be wondering, okay, how is this better than ROE? You may have already heard of ROE, and if you have not, please stop this video, go Google it and check out what ROE is. Now, why is it better? For me, is because The problem with ROE is that they often include things like cash. So you see, what you always want to measure is how efficient the amount of money that you've actually spent and used in and put into assets, how efficient that is. But if you have cash included, that's not a fair representation of how well the business is run. And that's, for me, is one of the reasons. There are many reasons, but that's one of the reasons why ROE is not a very good ratio in my point of view. Now, the next question you might be asking for ROIC is, what percentage is good? Now, there's no hard and fast rule, and you need to always understand it in the context of the business or the industry. But basically, any company that can make more than 8 or even 10% ROIC consistently every year is a sign that the business is very, very good. Now, but of course, again, you still need to do your homework to do more digging, because maybe the industry average ROIC is 15%. So then if you buy a company in the industry with a 8% or 10% ROIC, that might not be good. And you want to be looking for the 20% or the 25% ROIC in the same industry. So that's the little additional work that you need to do. Now, the next number or ratio. So a lot of investors, when they start investing, they always treat all debt the same, right? I don't want to buy a company with a lot of debt. And that's not necessarily a wrong thing. But if you want to be a more serious investor, the additional step you would take is to actually look at the debt and say how much of it is short-term and how much of it is long-term. Now, why is this relevant? Let me give you an example. On the surface, if you look at person A and he has 1 million in debt versus person B who also has 1 million in debt, you can't really say one has a better financial situation versus the other. Now, how can you actually tell whether one is better than the other? Let's say person A, out of that 1 million of debt, 800,000 is in a housing loan versus 200,000 in credit card debt. It's quite a lot, but still less than a housing loan. Versus person B, who has the reverse, 800,000 in credit card debt and 200,000 in housing loan. Now, can you see now it's totally different? I think most of us can agree the person with 800,000 in credit card debt, person B, is worse off than the person with 200,000 in credit card debt, assuming they have the same income, right? So now for a company, it's the same thing. You always want to prefer a company where they have way more long-term debt, which is usually used to finance productive assets like equipment, machinery, and property, versus short-term debt, which is used to finance working capital or day-to-day expenses. So usually when a company has a lot of short-term debt, that is a red flag to me, right? Because it means that the company is struggling to keep afloat. You never know, in the next month or even the next year, they might not be around. And that's why they have to keep taking a loan just to keep their head above water. So take note of that every time you just say, hey, I don't want to invest in a company with debt. Look further. If it has a lot of long-term debt, then the debt is a lot safer because it's backed up by assets, and also the interest rates are a lot lower than short-term debts. Next, we have the accounts receivable days. What does this number tell you, or ratio? Basically, it tells you how long does it take for your customers to pay you. If you recall, in my previous point in ROIC, accounts receivable is the amount of money that your customers owe you. Now, to take the additional step, you should be calculating, right, as let's say an ice cream store owner, how long it takes for your customers to give you the money. Wouldn't that be important? Isn't there a difference between if your customers pay you in 30 seconds versus 30 days? Wouldn't you prefer the one with 30 seconds? So before I explain a little bit further, I just want to share with you what the formula is. Basically, it's the accounts receivable, which you can get it from every balance sheet of every company, divided by the revenue, which you can get it from the income statement, multiplied by 365. that is your accounts receivable days. As a rule of thumb, you want the accounts receivable days to be shorter and shorter, right? But the important thing you need to take note, as with everything when it comes to financial numbers and ratios, is what industry is the company in. So you cannot say on the surface that if a company has an accounts receivable days of 10, it is better than the other company with 40 days. Why? Let me give you an example. For example, in the retail industry, let's say the shirt industry, on average, their accounts receivable days is anywhere between, let's say 20 to 40 days. But if you look at the semiconductor industry, that number on average can go up to 90. So you cannot say that, oh, the guy selling shirt, because he has a lower accounts receivable day, is better than the semiconductors. And very often, the reason the semiconductor industry has a higher accounts receivable day is because their clients are usually a lot bigger, so they can afford to drag out the payments. But let's not get too technical. So remember, don't just look at it in absolute terms. Please compare it to other industry peers. Next, free cash flow. What is free cash flow? Basically, it's the amount of money that the company generates after all the necessary reinvestments have already been made. What is the formula? It is operating cash flow, which you can get from the cash flow statement, less or minus capital expenditures. But it's usually called the acquisition or purchase of property, plant, and equipment in the cash flow statement under the investing activities section. Another pro tip that you should take note is that you cannot just use that. You should also add things like if they acquire subsidiaries or if they acquire other companies, that also counts as reinvestment into the company. When it comes to free cash flow, the more the merrier, right? It's an awesome business or stock when they don't have to put in a lot of reinvestments, but the free cash flow keeps going up. That's a sign of a very good business, because what that tells you, just look at the numbers, is that the company can acquire more customers without much reinvestments, or they can raise the price of their products without losing any customers or any additional reinvestment. So that's the ideal. But be careful, once again, make sure you understand the industry. Certain industries just require more reinvestments, like the semiconductor industry or the manufacturing industry, especially when you compare it to, let's say, tech giants such as Google or Facebook, where they don't have to reinvest too much to grow the business. So don't look at things in absolute, as I mentioned earlier on. Please compare it to their industry peers. Another pro tip, you can actually take the dividends and divide it by the free cash flow to get what we call the dividend payout ratio. What does this ratio tell you? Basically, it tells you whether management has your interest at heart. If they generate so much cash, but they're not paying out to you as a minority shareholder in the form of dividends, maybe the management doesn't really care too much about you. So you want to take note of that. So I hope that this video has leveled up your knowledge when it comes to investing or financial ratios. If you enjoyed the video, please share it with your friends. Remember to give it a like, comment, let us know if you agree or disagree with some of our points. Subscribe, notification bell, follow us on Facebook, follow us on Instagram. And while you're at it, come check out some of these other videos and see you in the next video. Bye-bye.